Every now and then, there's an event that no serious investor should miss out. And this weekend, one of those events took place in Omaha, Nebraska, the birthplace of arguably the best investor of our times, Warren Buffett. Yes, you've guessed it correctly. It was an annual shareholder meeting of Berkshire Hathaway, also nicknamed as the Woodstock for investors. It was presided by Warren himself and, unfortunately, this time without his longtime companion, Charlie Munger. This event is very closely watched by investors around the globe as it gives them the opportunity to gain an insight into Buffett's current thoughts about the state of the markets and potentially on his economic outlooks. And this year was definitely not short of highly important insights, such as why Warren Buffett decided to reduce his Apple stock, or why it is that Berkshire is sitting on the record amount of cash of $180 billion. And also the successor of Warren Buffett was finally discussed after he will no longer be able to, say, direct the Berkshire. Among other things, he also discussed whether he would invest in Chinese and Indian stocks. He touched on artificial intelligence, he discussed Tesla FSD, and shared his views on current state of US bond market. And not lastly, he explained exactly how he would get about getting rich again if he were to start over with only $1 million in his pocket. Even Tim Cook, CEO of Apple, was present in the shareholder meeting. So folks, you better stay tuned. Let's get right into it.
Brittle, bitches.
The whole meeting lasted for 7 hours, and I went through all of it and picked the most important highlights that may help you with your investment decisions. This time around, the shareholder meeting began somehow unconventionally, with an hour-long video of Warren Buffett and Charlie Munger that was a tribute to his longtime partner Charlie that unfortunately deceased 7 months ago when he was just shy of being 100 years old. This is highly depressing for Warren given how close they were with Charlie. Because of that, Warren was clearly less energized this time around and talked often about his memories with Charlie and other people, as if he was to doubt whether he will be able to preside the shareholder meeting in the next year. This is of course very sad because it's the people like Warren and Charlie that make America a great country.
Well, Mr. B, I look forward to serving as your number 2.
Well, actually, I already have a number 2. Meet Charlie, my Dwight.
You don't look so tough.
Well, actually, there are 18 ways I could kill you right now.
Anyways, let's get into the first highlight, the Apple stock. As you may know, Apple stock is the single biggest stock position in Buffett's equity portfolio. As of the end of 2023, this stock represented 50% of his managed portfolio, by far the biggest position. Now, he was trimming lightly in previous quarter this position, but he did reduce his Apple position significantly in the last quarter by selling 150 million shares of Apple, which represents around 13% of his total stock holding. So it still represents by far the biggest equity position in his portfolio, and he did mention that Apple is, according to him, the best stock that he currently owns, greater even than the, say, Coca-Cola or American Express, which are the third and fourth biggest positions in his portfolio respectively. Also, he believes that those investments, namely Apple and Coca-Cola and American Express, would stay on the top of his portfolio even in the time of his death. As to the reason why he decided to reduce his Apple holdings, he said that it is attractive right now to increase the cash position given the events that are currently taking place around the world, and that he thinks there are attractive alternatives on the stock markets in the present moment. Now, it remains to be seen if he invested in other stock, as hedge fund managers are obliged in the next 2 weeks to reveal their US equity positions within the 13F filing law as of the end of the first quarter 2024. By the way, the red rectangle shows the time period where Buffett was selling those 13%, probably closer to the top, but nobody really knows but him. If I had to guess, he did it because he simply thinks stocks may be overvalued and he saw more merit in holding cash. Hand in hand, someone asked Buffett about his massive cash position in the Berkshire. From this chart, it is evident that his cash pile is becoming massive, now residing at approximately $180 billion US. Buffett added that he believes by the end of second quarter this cash pile will further increase to $200 billion. So the question was, Warren, what are you waiting for? Why don't you invest these funds in some way? Buffett answered that he and his management simply don't see any attractive investment opportunities in the current moment. He added that he does not consider it to be a right approach to invest simply for the money to be invested somewhere so they are not on the sidelines. In other words, Warren invests only when he finds it truly attractive. He does not FOMO in, and as his partner Charlie Munger said, it takes a true character to be patient enough to sit on cash for long periods of time. Moreover, cash is currently quite attractive alternative given that Warren is gaining about 5.4% interest on his cash holdings by investing those funds into the government bonds with short maturity, like 3 to 6 months bills. However, he added that even if interest gained on his cash was only 1% instead of 5.4%, he would still hold the equivalent amount of cash on the sideline. Now this tells you that he is really adamant about building his cash position in the current time for whatever reason.
I don't think anybody sitting at this table has any idea of how to use it effectively, and therefore we don't use it, and we don't use it now at 5.4%, but we wouldn't use it if it was at 1%. We only swing at pitches we like, and if anybody tried to swing at every pitch or felt that because they hadn't swung at a pitch for the last 2 pitches, they ought to swing at the third one or something like that. It isn't like I'm got a hunger strike or something like that going on. It's just that things aren't attractive. And
in my opinion, this is an attempt to hedge against sharp stock market declines that may take place in the next several months. He is de-risking his portfolio, which makes perfect sense to me, since that's exactly what a prudent portfolio manager would do if he considered valuations to be stretched. Warren was asked if he would consider investing in Chinese and Indian stock markets currently. In case of China, he answered that he would always prefer to invest in American business, for which he received, by the way, an applauding audience. At the same time, though, he reasoned that although Berkshire may not significantly invest in purely Chinese companies, many of the stocks that he currently holds in his portfolio are exposed to Chinese markets, so he's not entirely missing out on potential growth of China. Think of Coca-Cola or Apple. They sure as hell do sell their products in China, but are based in USA, which takes regulatory and political risks out of the equation. USA is much more reliable in a sense of predictability of the laws, institutional reliability, and private ownership protection as opposed to China. Now, in regards to Indian equity, he was less skeptical, and he admitted that there are exploitable opportunities for Berkshire in Indian market, given to the size of the economy and potential for future growth. If you didn't know, India is the most populated country in the world, at the same time with very young populace. This is huge advantage in terms of potential for future organic economic growth. Buffett also said that he doesn't feel that he himself is competent enough to compete in the Indian market, but he did pitch the idea to his potential successors, saying that this might be one of the viable goals of the future Berkshire management. Now this one is an interesting piece of advice straight from Warren for both new and advanced investors. During previous shareholder meetings, Buffett used to say that if he were to start over with his investment career with only $1 million in his pocket, he claimed he would be able to grow it much faster than the current Berkshire portfolio due to its size. And he said he could manage to make as high as 50% return on an annual basis with the small money. One of the shareholders asked him how exactly would he achieve that kind of return. What kind of analysis would he conduct to assure such a return? What would be his method? Well, Buffett answered that, not surprisingly, he would do it exactly the same way as he was doing it when he was 20 years old. At that time, he said he would passionately read over the Moody's Industrial, Transportation, or other manuals. Now, I was curious, so I looked it up to see what is there in those manuals. These manuals have 1,000 or 2 of pages full of very basic information about all the publicly traded companies in a given, say, sector. This way, you could go over all of them in the given sector and become briefed on their history, financial performance in the last few years, see the names of the managers, learn how many stocks and bonds the company has issued, its credit ranking by Moody's, etc. So there you really may find stocks that nobody pays attention to and delve deeper into those companies. And if you do the right analysis, you will pick the future winners in the given sector and you will be among the very first investors. Therefore, the growth potential is really huge there. Imagine buying Tesla when it produced a couple of cars only, or Nvidia when it was in its very beginning. So this approach does make sense to me. You would just have to find today's equivalent of Moody's manuals and spend heck a lot of time going through these basic records. The next step, I imagine you would narrow these thousands of companies to only a handful of the most interesting stocks and then delve really deep into each of them, trying to analyze them separately. And then maybe, if you've done it well, you will find that future winner. Now, Buffett rightly pointed out that this must be your interest. You can't hope to do it well if you are not truly curious and don't derive happiness from expanding your knowledge in the given sector. Buffett would passionately go over these manuals even more than once and study these companies in a highly detailed manner. So if your only goal is money and you're not passionate about it, this method is probably not well suited for you. Another great question from one of the shareholders was about Tesla full self-driving software. For the context, Berkshire's main business line is insurance, and this includes automobile insurance. Elon Musk boasted that if FSD autonomous driving was implemented in the United States, it would reduce the crash incidence by about 50%. Now, some people don't believe that full self-driving is even possible, so that remains to be seen. However, I wouldn't want to be on the other side of the bet against Elon Man.
Charlie, have you seen the new trailer for Iron Man 3? It's really amazing.
Iron who?
But in case FSD succeeded, that would be of course a problem for insurance companies such as Geico that is owned by Berkshire. Less incidents means less profit for insurers, so the question was, how would Geico react to FSD implementation, should it happen? Ajit Jain, the director of Geico, softened the blow by saying that even though crash incidents may really fall by half, the costs incurred during those incidents are rapidly growing, which would partially offset the lower incidence rate for insurers, since higher costs would force more people to consider insuring the car. He also was skeptical in regards to Tesla attempting of providing insurance services of its own on its own cars, as there has been very little progress in that direction so far. As Buffett gets questioned about the technology of generative artificial intelligence, he admits that he doesn't have much to say about the topic of AI, as it is clearly outside of his circle of competence. Buffett and Munger would often urge investors to avoid making bets in the sphere or sectors where they do not have competitive advantage. But he did liken the AI technology to genie in the lamp and nuclear weapons. He said it could be a great benefit for the world, but also a great danger, and once the genie is out, we will not be able to put it back in, just like with nuclear weapons. He also added that he expects due to AI integration, the leisure time of general populace will rise, and it will also be used to scam people. Therefore, opportunistic investor could benefit from finding the businesses that will be able to absorb the chunk of the excess leisure time that will be created due to this technology, probably in the sphere of entertainment.
When you think of the potential for scamming people, if you can reproduce images that I can't even tell, that say, I need money, it's your daughter, I've just had a car crash, I need $50,000 wired. I mean, scamming has always been part of the American scene. But if I was interested in investing in scamming, it's going to be the growth industry of all time. Based on the one I saw recently, I practically would send money to myself over in some crazy country. It has enormous potential for good and enormous potential for harm, and I just don't know how that plays out.
Now, this is a crucial question, especially for Berkshire shareholders. Who will inherit Berkshire and lead its success in the future when Warren is no longer able to? Buffett didn't seem to be worried at all about giving the responsibility to his left-hand man, Greg Abel. Why the left-hand man? Well, because, of course, his right-hand man was and always will be...
I'm right.
Who's that, Charlie? Oh, give me the phone. Give me the phone. Give me the phone. Charlie, it's Jamie. Hi. Oh, it's so fun talking to you, too.
Greg Abel and Ajit are already directing Berkshire to a high degree because Warren himself admitted that he doesn't receive many calls from the subsidiary managers and most of the operations are handled by Greg. Given his age, Buffett is no longer able to be as effective in his work as he used to be when he was younger. That's why I think he predominantly concentrates on equity portfolio management and occasionally gives some advice to management team. It seems that he's comfortable with fully entrusting Greg in his role of both CEO and equity portfolio management. He claims that Greg is highly experienced and he understands businesses very well. Greg commented that his approach to leading the Berkshire will remain unchanged from that of Buffett because there's a culture of fundamental investing imprinted in all of the managers inside of Berkshire.
Knowing Greg, I would leave the capital allocation to Greg. He understands businesses extremely well, and if you understand businesses, you understand common stocks. I think the responsibility ought to be entirely with Greg. I think the responsibility should be that of the CEO, and so I would say that my thinking on that has developed to some extent as the sums have grown so large at Berkshire. And we do not want to try and have 200 people around that are managing $1 billion each. It just doesn't work. I think that when you're handling the sums that we will have, you've got to think very strategically about how to do very big things. And I think Greg is capable of doing that, I think.
As we go through any transition, it's important to know that the capital allocation principles that Berkshire lives by today will continue to survive, Warren.
You must understand that Berkshire Hathaway created a community, almost like a religion, where its stockholders are highly loyal to the company, and management team is part of the culture that was created by Munger and Buffett. Also, in the worst case, there's a board of directors that will always watch over CEO activities, and some of the people on this board are Buffett's wife Susan or his son Howard and other friends of his. Buffett believes Berkshire is well positioned to function for another decade and more at least. Therefore, I assume the Buffett culture will survive him for many years to come. Among other interesting questions, there was a question in regard to the state of US bond market. Some investors are worrying that given the large amount of new debt issuance by US government, there might be issue with demand for these bonds. Buffett is not worried about the quantity of bonds, he said. He's rather worried about the fiscal deficits. Of course, hard deficit means there will be higher taxes in the United States in the future to lower them. Warren, however, did not protest against that because he thinks it's thanks to those taxes that American people can enjoy a highly prosperous economic environment. He even said that if all of the 800 biggest companies paid taxes as they should and did not avoid them by numerous measures, there would be absolutely no need to tax the ordinary people. No income tax, no social or real estate tax would be required at all. That's very interesting. For this, he again received an applauding audience. He repeated also that given that there's really no alternative to US dollar, he would not be too worried about the ability of US government to raise money, as long as financial system is stable and inflation is in check. Berkshire refuses to pay out dividends for a long time because it believes it can reinvest cash back into the business to grow value at a faster pace than investors could. And I personally agree with this approach. Investors will essentially get their dividends with a time delay in the form of capital appreciation of the stock price. And it also may be tax efficient over dividends.
Hi, Charlie. I'm Susan Lucci. Oh, haven't you heard about the deal between Warren and me? He's going to be a big star at All My Children, and I'm going to be taking over Berkshire Hathaway.
Well, you've certainly got some important qualities that Warren lacks.
Well, thank you, Charlie. There's some changes I really think we need to make around here. The first thing we need to look at is our dividend policy. I have never heard of anything so cheap and so unfair to our wonderful shareholders. We need to change it.
Sounds good to me.
Okay, I hope you take something useful from this video. It took me a huge amount of time to produce this, and I will look forward to providing similar highly valuable insights in the future. So please make sure you're subscribed to my channel so you don't miss out, and feel free to leave a like. And also, there's a present for all of you who made it to the end of this video.
1, 2, 3.
Warren Buffett.
Jesse. All right. I'm going to call my partner and have him draw up the papers.
Wait a minute.
Did you just put that piece of brittle back in the batch?
That's right there.
Contaminated the whole thing.
Charlie? It's done.
Slick, yo. Brittle, bitches.